Have you ever just sat there watching a candle spike, felt that massive wave of FOMO, smash the buy button, and then boom, you watch it instantly crash right back down before the clock even runs out? Honestly, how often have you been totally faked out, losing your hard-earned money just because you jumped the gun before a candle officially closed? Well, welcome to this explainer on mastering the bullish and bearish Harami candlestick patterns. We're going to unpack exactly why this happens and, way more importantly, how you can stop it from ever happening again. Here's our roadmap for today. First, we're decoding the Harami patterns. Second, we'll look at the two-candle trap. Third, spotting the head fake. Fourth, the art of confirmation. And finally, building ultimate conviction. We're going to move pretty fast here, going straight from basic definitions right into high-conviction techniques. Okay, let's dive into part one, decoding the Harami patterns. Reading the bodies, not the wicks. Let's get our baseline set up here. So, a Harami, which a lot of traders just call an inside bar, is a two-candle pattern. The golden rule you gotta remember is that the body of the second candle has to be entirely contained within the body of the preceding first candle. Now, notice how we are strictly talking about the mathematical bodies of the candles here, the solid colored blocks. For this core definition, we are completely ignoring the wicks. Just pretend they aren't even there for a second. And hey, keep in mind, real-life charts are almost never textbook perfect. That inner second candle isn't always going to fit flawlessly dead center inside the first one. It might sit a little closer to the bottom or maybe closer to the top. And you know what? That still technically counts as a Harami, just as long as the body is fully contained. And this brilliantly illustrates the two main flavors you're going to encounter on your screens. On the left, we've got the bullish Harami. This pattern typically shows up right at the exhaustion point of a downtrend, so you'll see this big red downward candle, followed by a gap up into a smaller green candle that's just trapped inside that previous red body. Then over on the right, it's the exact opposite setup, the bearish Harami. This guy pops up at the end of an uptrend featuring a big green candle followed by a smaller red one. Now, while it's absolutely crucial to understand both to truly master bullish and bearish Harami candlestick dynamics, our main focus for this explainer today is really going to be on mastering that bullish variation, so we can learn to spot that potential reversal right off the bottom.
All right, moving right along into part two, the two-candle trap, and why the basics just aren't enough.
This is exactly where we enter the danger zone of the chart. I mean, it is so easy to spot that little green inside candle, feel a massive rush of adrenaline, and just blindly pull the trigger. But as our source material perfectly puts it, the basic two-candle Harami setup is just mildly somewhat bullish. That's it. Yes, seeing that small green body contained inside the red one tells us that the current downtrend might be taking a breather. It's a signal that maybe, just maybe, the bears are finally losing their grip and the bulls are getting ready to step up. But honestly, a hint is fundamentally incomplete. By itself, this two-candle formation is literally never enough to confidently enter a long position. It's just not serious business yet. Because here is the harsh reality of the markets. These candlestick shapes do not work 100% of the time. No way. If you just blindly rely on spotting a basic two-candle setup and immediately risk your capital without getting any further evidence, you are walking straight into a guaranteed trap. Which brings us to part three, spotting the head fake, the villain of the chart. Now, what's really interesting here is how this introduces the absolute worst nemesis of the impatient trader. Market expert David Modell points this out perfectly in our source analysis, saying, look at this fake out, look at this head fake. Let's just visualize this scenario for a second. Imagine you're watching a super fast-paced one-minute chart on a volatile stock, let's say Apple. You've spotted your initial bullish Harami. You're watching. And then suddenly, the very next candle starts shooting straight up. I mean, it is surging rapidly past the previous candles. It is so incredibly tempting to look at that real-time intraday action, completely give in to FOMO, and buy in early because it looks exactly like a rocket taking off. But right at that exact moment of maximum excitement, you gotta stop and ask yourself a critical question. Did the candle actually close, or is this a trap? Because if you gave in and bought during that sudden upward spike, you probably experienced a trader's worst nightmare. Right before that 1 minute period ended, the price came crashing all the way back down. It completely failed to hold those highs. It just left behind this long, thin upper wick. And that, my friends, is a devastating head fake. You're now stuck in a bad trade purely because you reacted to unconfirmed movement instead of finalized data. Let's fix that. Part 4. The art of confirmation, going from mystery to mastery. Okay, let's relieve some of that tension because there actually is an ultimate mechanical solution here. Think of this as your chronological battle plan to trade this safely. Step 1, you spot the initial Harami pattern printing on your chart. Step 2, you literally sit on your hands, step back, and patiently wait out the subsequent candles. It might be the very next candle, or, it might take 2, 3, or even 4 more candles to develop. You just watch. And then, step 3, you finally get that confirmation. What you're looking for is a strong green candle that physically closes above the top of that initial big red body. You wait for the clock to strike 0 on that trading period, and only when that close is totally locked in above that line do you proceed.
Bam! That is conviction right there. So the crucial takeaway here is that you are waiting for the definitive arrival of a strong green confirmation candle that officially clears the structural high of that preceding red body. Once it actually closes above that level, it is no longer just a mildly, somewhat bullish hint. It becomes a loud, mathematical declaration that the bulls have completely absorbed all that selling pressure and are ready to send the asset upward. All right, moving into our final section, Part 5, Building Ultimate Conviction by Adding Layers of Proof. Let's see how we can build a rock-solid case that really stacks the trading odds in your favor. Instead of just relying on one isolated piece of price action, let's treat this like a giant puzzle to find real confluence. Look at these extra layers of proof we can uncover. First up, check the volume at the bottom of your screen. If that confirmation candle comes with a massive green volume bar, yeah, we're likely seeing institutional money backing the play. Next, look extremely closely at the shape of that confirmation candle itself, because it reveals a lot. If it has no lower wick, it means from the absolute second that period opened, the bears had zero control. The price just went straight up. And if it has no upper wick, that means it closed at the absolute undisputed high of the period without a single ounce of seller pushback. When we combine those powerful candlestick signals with external indicators like moving average crossovers, the MACD, RSI, or stochastics, we can actually start transforming a simple visual pattern into a highly probable, high-conviction trade setup. Which leaves us with one final, pretty provocative question to chew on. Will you have the discipline to wait for the confirmation close on your very next trade? Because look, the shapes on the chart, they're just data. The real wild card in trading is human psychology. Mastering the bullish and bearish Harami candlestick isn't just about memorizing where a green box sits inside a red box. It's about completely conquering your own impulse to jump the gun. As we've seen throughout this explainer, waiting for that confirmed close isn't just some basic safety precaution. It is literally the secret to successful, high-conviction trading.